Welcome to Edison's new series, Real Assets in an Uncertain World. We live in an era of increasing geopolitical instability, higher inflation, and tightening monetary policy. Can investing in real assets provide sustainable, less correlated returns? Industry leaders from sectors such as renewables, infrastructure, media and technology are joining us to reveal their views and deliver actionable insights for a global audience. In this session, I'm delighted to welcome Christopher Abbate, partner and co-head of the credit business at Riverstone, an asset management firm investing primarily within energy, power and infrastructure. Welcome, Chris.
Thank you for having me. Very nice to be here.
Now, tell me first of all, if you would, why you think that real assets are such an important investment class sector in 2022?
Sure. Well, firstly, we invest as the lenders. We lend money, and all of our loans are floating rate. So, you know, our angle on real assets is almost a perfect inflation hedge for what we see going on. In addition, the companies we invest in are part of the global energy and power infrastructure. And that is also a good hedge against what you see going on in the world today. And as a matter of fending off inflation and obviously the commodity price increases. So somewhat of an obvious question for me. Thank you very much, but we seem to be in the sweet spot for what's happening in the world right now, and we're glad to do it.
Now, tell me a bit more about Riverstone and its model.
Sure. So Riverstone is a firm that's about 22 years old. It was founded in the year 2000 by two ex-Goldman Sachs partners, David Lucian and Pierre Lapierre. They founded the firm to really be almost like a merchant bank for the energy and power sectors. They wanted to build companies, partner with management teams to really build unique businesses across the energy value chain. So we started out doing oil and gas, of course, pipelines and infrastructure, did a lot of renewables. We've done a ton of wind and solar and biomass. And today we are a leading investor in what we call decarbonization growth, which is sort of again, partnering with teams that are attacking climate change in the energy sector as well as industrials and agriculture. About 8 years ago, they hired myself and my partners to come in and build a credit business, where the idea was really to draft behind the overall franchise, and instead of being equity investors, be credit investors, where we basically look at the same things that they're looking at on the equity side, benefit from all that expertise, and then make senior secured loans, which is a lower risk, lower return proposition. But certainly, just as challenging in terms of the sectors that we focus on. So it's good to be part of a bigger organization.
And you've begun to flesh it out there, but what are the opportunities of lending into this niche energy sector that you're so invested in?
Sure. Well, the energy power sector has historically been one of the best banked sectors in the economy, routinely capturing the leading market share of both commercial bank loans and capital markets activity. The need for capital in the energy space is enormous. And because the sector is so asset intensive, the credit losses for lenders have historically been very small. However, in the post-financial crisis era, our sector is not immune to the pressures on banks and capital markets to lend to larger or more mature companies. The need for alternative credit or non-bank lending services in energy and power is not unique, but it is large and underserved. And that's where we really see the opportunity. Whereas most sectors are overwhelmed with offers of credit from the so-called generalist direct lenders like Golub or KKR or Antares, most of these folks have either ignored or avoided the energy and power sector. And we purpose-built our strategy and product for small to medium-sized companies focused in this space. And we've seen very little competitive pressure over the past 7 years. Specifically within our space, because it is so well banked, once a company is large and mature enough, we think the best opportunity lies with what we call transitional credits. And these are companies that are transforming or going through an evolution that will result in a material decrease in their cost of capital. Examples we use all the time, but either you're building like a pipeline or maybe a solar farm where the tenant, the intended user of the asset, is non-investment grade. If these projects had investment grade counterparties, they would likely qualify for project finance from a bank. With non-investment grade counterparties, these projects have historically been 100% equity financed until they are completed and cash flowing, when the bank can then go in and actually do some credit analysis to determine credit capacity. We believe that these situations are perfect for our product. We're less expensive than equity, but we sit senior in the capital structure and provide no more than 60% of the overall capital, which leaves significant cushion in case there's an issue. And once a project is complete and cash flowing, the sponsor can then replace our expensive debt with something much cheaper. We cash out and roll our capital into a similar project, sometimes for the same company, sometimes for the same sponsor. The model of bridging these transformations allows us to limit our exposure to the various economic and commodity cycles that come our way, and continually reevaluate our loan to value, taking considerable profits along the way. Our core skill set is evaluating each company's ability to successfully transition, because typically once the transition is complete, a refi of our loan is almost a certainty. Where there have been issues is where the transformation has interrupted along the way due to liquidity issues or market-related issues or otherwise, including but not limited to a global pandemic, for example.
So what are the typical lending terms and loan structure?
Sure. So we, being project style lenders, we typically structure our deals as 3-year delay draw loans. The borrower is permitted to fund a certain portion of the loan at closing, depending what the needs are and what the collateral value is at the time. Over time, more of the loan will be made available as they meet certain milestones, such as additional equity coming in alongside the loan, progress on the project, etc. As more of the loan is funded, more collateral value is also created. The deals are typically priced at SOFR plus 750 to 900 over, with 2 to 4% in upfront fees and then exit fees on the back end. Each deal is specifically structured to match the business plan of the borrower and their expected timetable for their transformation. There are numerous active and passive features in the loans that all encourage the company to complete that transition as fast as possible and to refinance this. These include economic incentives like step-ups in the coupon or in the exit fees over time, but also tightening financial covenants, amortization, and other features that encourage early repayment. All the deals have at least 2 financial covenants, one measuring loan to value and the other measuring liquidity. And we've had deals with as many as 5 covenants. We typically are only involved in transactions where Riverstone Credit is the lead investor, originating the deal and controlling the documentation and post-closing monitoring of the credit. And while there has historically been opportunity to participate in other people's deals, we found that the best way to protect the principal in a troubled situation is when we are in the driver's seat ourselves.
It's a really interesting model. And how do you leverage off the Riverstone group? Presumably the expertise is key.
Absolutely. As I mentioned, the original idea was to draft behind the Riverstone franchise and the Riverstone network. So we thought attaching our loan to value, short duration lending model to one of the largest private equity players in the market focused on energy and power was a really good idea. The breadth, depth, and operational expertise found at Riverstone has allowed us to evaluate any energy project anywhere in the value chain, anywhere in the world for the last 8 years. As Riverstone has shifted from traditional energy and power to more decarbonization focused investments, so too has our lending focus shifted. And the same benefits we used to get from looking at an oil and gas project with Riverstone, we now get when we look at something like our investment in a lithium-ion battery manufacturing company called IM3 New York, which you can see in our materials. Whereas our team is in the credit side is responsible for originating the deals and doing the due diligence on underwriting and structuring. It is very nice to have a deep bench of investment professionals, management teams, both present and past, outside advisors, and consultants that make up the Riverstone network by our side. We also benefit, of course, from the platform in terms of significant expertise around accounting and finance, legal, compliance, and ESG functions, where we feel like Riverstone is best in class.
So we're accelerating now towards net zero, thankfully. But what's your approach to ESG and green lending? Just briefly.
Sure. It's a great question, particularly in today's environment. As an investor focused solely on energy and power, we've had no choice but to be very focused on ESG for a long time. And right now, I think we are seeing how the E and the S within ESG can come into conflict as a combination of, on the one hand, underinvestment in fossil fuels and supply disruptions caused by geopolitical tensions has led to severely elevated commodity prices that hit consumers hard. That's the S part of ESG. We see really two big problems that the world faces right now. On the one hand, energy demand globally is expected to grow by 50% over the next 20 to 30 years. And this is a key component to raising the standard of living for people in both the developing and developed economies. Without access to reliable, affordable, and clean energy, it's hard to see how this type of economic prosperity is possible. Meanwhile, however, as you mentioned, we must transition the energy economy from one based on hydrocarbons today to one that is zero carbon in the future. And we need to accelerate the investment required to make this happen. 2050 might not be soon enough, frankly. So how do you achieve both goals at the same time? We at Riverstone, we think it's possible. And in fact, we believe that the small to mid-market companies that we focus on are going to be at the forefront and a leading agent of change. First off, for the past 2.5 years, Riverstone Credit has avoided the least carbon-friendly parts of the energy business. We no longer are looking to lend to upstream companies that actually drill and operate the oil and gas wells. And we haven't done anything in the coal sector for over 5 years. Today, we are solely focused on energy infrastructure services, and energy transition. In addition, in order to bring some focus and structure to our process, we have decided that all loans going forward will be structured one of two ways. First, the loan will be evaluated as to whether it will qualify as a green loan. And for this, it's relatively simplistic, but the use of proceeds of the loan need to be tied specifically to meeting one of the UN's Sustainability Development Goals, the SDGs. If a loan can't be structured as a green loan, however, we will evaluate as to whether it can be structured as a sustainability-linked loan. In order for this to be possible, the borrower must have goals set by their board of directors that have a meaningful impact on improving sustainability and reducing carbon emissions. The goals must be ambitious, but measurable and auditable. We then tie our loan economics to meeting these goals within a specific time frame. If the goals are not met, typically pricing on the coupon will step up by 50 to 100 basis points. We believe that engaging with companies with structures like this and making them put their money where their mouth is the best way to keep expanding energy infrastructure on the one hand, which of course is a key requirement to meeting the demand growth, but at the same time, cleaning up the existing infrastructure. Given that the energy business today is responsible for something like 25 to 40% of GHG emissions, it seems to me the fastest way to get to net zero is going to be to engage with the existing participants and demand ambitious change as a requirement for our capital going to work. Using these two structures, we believe that every loan we make will be going towards the goals of safe, reliable, and affordable energy for all, while at the same time having a positive impact on carbon emissions and the goal to get to net zero.
It's such an interesting business model, and we could talk to you for a very long time. Sadly, we must wrap it up. Christopher Abbate of Riverstone, thank you so much.
My pleasure. Nice spending time with you. Thank you.